I think the economy remains very strong on a very solid footing. We see good business optimism, good consumer confidence. We don't see any real excesses across any of our borrowing bases. GDP growth is strong this year, should carry on into 2019, and all that bodes well for continued loan demand, which obviously helps our top line. The higher interest rates is a benefit. We still are asset sensitive, so as the Fed raises rates, that benefits our net interest margin. It's a little less so today than it was going back a year ago when we were earlier in the rate hike cycle. We now have to catch up a little bit on our deposits, so our deposit betas are going up, but it's still net positive. And I think as long as the Fed continues to raise rates gradually, either households or companies have been able to absorb that higher cost of carry on their debt.
Talk to me a little bit about the thing you just mentioned, and that is having to raise deposit rates. It's been a long, long time since you've had to do that.
Well, we started to see a bit of a push on for higher deposit rates from our commercial borrowers, kind of the first avenue, because as their loans, which are tied to LIBOR, reprice, and they're paying us more for the loans, and they want to get paid more on the cash that they leave with us. Second avenue has been wealthy depositors who have more cash, so the interest rate matters more. They've also started to push a little bit for higher rates. The mass consumer, not as concerned about it, because if you have $800 in your account, a 1% difference is $8. It's not that big a deal. So we're still lagging, I'd say, in the mass consumer and starting to pick up the rate rises on the other two.
I guess you could go to Starbucks once.
Yeah, get a six-pack maybe.
Yeah. Bruce, you're seeing a very nice day today. It's been a tough year for your company as well as a lot of other financials, and a lot of that has to do with the spread, the 2's10 spread. And one analyst had pointed out to us on Power Lunch that there's about an 80+% positive correlation between regional banks and how they trade and the 2's10 spread. How should investors think about that? Is that the right way to think about that relationship, or should we be looking at something else?
I think that's a little narrow. That's a little bit of a narrow lens. So while a flatter curve does impact net interest income, most banks have most of their exposure to interest rates at the short end of the curve. For example, we have about 75% of our exposure at the short end. So as the Fed is raising rates, that's still beneficial. I think one of the things that investors should be looking at is, how are banks doing in terms of growing their top line, investing in new capabilities, doing more for their customers, building out their fee-based capabilities so that they can grow their revenues faster than their expenses. That's something we've actually excelled at. Last year, we grew our revenues 10% and kept expenses to a 3% growth rate. This year, year to date, we're about 7% revenue growth over say 2.5 on expenses, or 3, so about a 4% differential. So that, if you can continue to do that, you're going to continue to drive your earnings per share growth and your improvement in your return on equity.